Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, July 21, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Let's get right into it.
Yeah, so right now, there is a $500 billion tidal wave of artificial intelligence debt that is just quietly breaking the pipes of the bond market.
Right.
And, it is positioned to impact basically every single broad bond fund you might hold in your portfolio.
It really is.
Because if you look at the board today, it looks, chaotic, right? Technology stocks are squeezing higher, oil is breaking out, and bank earnings are just completely splintered.
Yeah, all over the place.
But there is actually a single invisible thread tying all of this together, which is a rapidly shifting global cost of capital. So for this deep dive, we're going to frame the current environment around three critical themes driving institutional money today. First, we will examine the collision between stalling global rate cuts and that massive AI-related debt supply we mentioned.
Right. The macro picture.
Exactly. Second, we'll dissect the mechanical option squeeze that capped the S&P 500 today, along with some glaring valuation contradictions we're seeing in the software sector.
Yeah, there's a lot to unpack there.
For sure. And finally, we'll unpack the simultaneous breakouts in physical commodities and why sophisticated capital is hedging against a prolonged geopolitical shock in a very specific way.
Got it.
Let us begin with the foundational cost of capital, because today's macro drivers are heavily influencing everything from equity flows to, literally the price you pay at the pump.
Right. The upward pressure on yields is very pronounced right now.
Yeah. Looking at today's close, the 10-year yield rose 4 basis points to 4.630%.
Mm-hmm.
And the 2-year yield rose 6 basis points.
Yeah.
But perhaps most critically, for anyone allocating capital right now, real 10-year yields, meaning the yield you get after adjusting for inflation, have surged over 2.3% this month.
Yeah, and to understand the mechanics behind this surge, we really have to look at how structural inflation expectations are shifting higher.
Right.
Because geopolitical tension is steadily pushing up physical energy costs. And we are already seeing this cause Latin American headline inflation to rebound aggressively.
Aggressively is the word. According to our internal models, it is now forecasted to hit 4.8% by December 2026.
Correct. Now, you might wonder why Latin American inflation matters to a domestic portfolio.
Right. Why should people care?
Well, it functions as the proverbial canary in the coal mine for global supply chain pricing.
Yeah, it's a leading indicator.
Exactly. When emerging market inflation re-accelerates like that, it signals to the broader market that the global rate cut narrative is stalling.
Because the local banks have to react.
Right. Regional central banks that were easing are now being forced to stabilize or, even raise policy rates just to defend their currencies.
And then domestically, the Federal Reserve is reviewing its framework with a noticeably hawkish tilt.
They are. Indications suggest they're actively considering less forward guidance transparency, which is huge, and a reduced pace of quantitative easing.
Which sets a highly restrictive macroeconomic stage. But we also have a massive corporate driver complicating the rate picture here.
You do.
In today's data deck, we are tracking $489 billion in year-to-date AI-related debt issuance.
Which is just a staggering figure.
It vastly exceeds all previous institutional estimates. To put the sheer scale of this into perspective, this single category now accounts for roughly 23% of all U.S. dollar investment-grade gross supply.
Right.
And 20% of high-yield supply. So applying the first principles rule here, can you explain simply how this massive AI debt supply actually impacts regular fixed-income investors?
Well, let me frame it using a structural analogy.
Okay, yeah. I look at the broader bond market like a city's municipal water system, right?
Right, exactly.
It's designed to handle a certain predictable amount of capital flow.
Yeah.
But suddenly, the system is forced to handle the runoff from a massive new reservoir.
And that's this $489 billion of AI debt.
Yeah. So when you open the floodgates from that new reservoir, the existing pipes are going to stretch to accommodate the sheer volume.
Correct. In the fixed income markets, those pipes are credit spreads.
Right.
When hundreds of billions of dollars are suddenly demanded by technology companies building out, massive data centers and compute clusters, it absorbs the capital that naturally would have gone to other corporate borrowers.
Because the market only has so much liquidity.
Exactly. The liquidity isn't infinite. So to attract buyers, bond issuers across the board are forced to offer higher yields.
Right.
And this dynamically widens credit spreads across investment grade, high yield, and leveraged loan markets.
Which directly impacts where institutional capital is hiding out right now.
Precisely. Because if you are an allocator managing billions, you want to position your capital where the pipes are not currently being stretched to their breaking point by this AI debt deluge.
So where are they going?
Well, because of this supply dynamic, institutional consensus currently favors BBB-rated bonds over BB or AA-rated peers.
Okay. Why BBB specifically?
The reasoning is entirely structural. The AA-rated space is heavily crowded with this exact technology debt we just talked about.
Right, the AI stuff.
Yeah, and the BB space carries too much fundamental default risk in a rising rate environment.
Makes sense.
So the BBB cohort offers a structural sweet spot right now because it faces smaller supply headwinds, which allows the credit spreads to remain relatively stable while, still offering a compelling yield.
Moving to today's data, we have to examine how the equity market is navigating this rising cost of capital.
Yeah, it's been volatile.
Well, the S&P 500 closed today at 7,508.52, which is up 0.9%. But the underlying market mechanics dictate exactly how we arrived at that precise number.
They really do.
Because when you dig into our daily desk data from this morning, the market gapped up and was immediately squeezed by dealer hedging up to a very specific level at 7,515.
Right, the key technical level.
Yeah, and when I look at the 7,515 level, it looks like a classic positive gamma shelf. It seems like dealers were essentially forced to sell into the rally, which built a brick wall at that exact price, capping the index. Am I reading the mechanics right here?
You are. When we talk about dealer gamma, we are mapping the mathematically forced hedging activity of options market makers.
Okay.
If you are a market maker, your goal is to remain perfectly neutral, right? Not to bet on the direction of the market.
You just want to collect the spread.
Exactly. So before the open, the market was sitting in a negative gamma sliver just below 7,515.
Right.
In a negative gamma environment, the math dictates that as the index price rises, options dealers are forced to buy the underlying index to keep their books neutral.
Meaning they are buying as the market goes up and selling as it goes down.
Correct. And that forced buying acts as an accelerant. It squeezed the market straight up, creating a vacuum that pulled the index directly to the 7,515 level.
The zero-G pivot.
Exactly. Right at 7,515, the environment flipped from negative to positive gamma.
Okay, so the math changes.
Completely. In a positive gamma regime, the hedging math reverses entirely. Dealers are now forced to sell into strength and buy into weakness.
Oh, I see.
So the moment the S&P 500 touched that positive gamma shelf, dealers mathematically flipped from buying to selling.
Which operates as a structural ceiling.
Yes. The market ground its way up to the flip, found zero fuel above it because the dealers were suppressing the volatility, and settled right on the knife's edge at 7,508.52.
That mechanical price action really masked some aggressive sector rotations underneath the surface, though.
It did. There was a lot going on.
Yeah, today's proprietary updates highlight a violent rebound in momentum factors, which closed up 3.5% today. But that domestic strength stands in stark contrast to the weakness we are tracking in Asia. The Kospi was down roughly 4 to 5% today, leading a downward slide in domestic semiconductors and memory names overseas.
It's a real divergence.
And speaking of divergence, if you are holding a standard technology exchange-traded fund right now, you also need to look under the hood at the severe split within the Magnificent Seven itself.
Right.
Tesla gained 2.5% today, and NVIDIA gained 2.0%, yet Alphabet slid 1.4%, and Microsoft fell 1.1%.
Yeah, and this divergence is happening right ahead of Alphabet's highly anticipated earnings report tomorrow.
Exactly.
The institutional focus there is going to be intensely fixed on capital expenditures, specifically when these massive AI investments will actually begin to generate return on invested capital rather than just burning cash.
Well, let me challenge another sector defying gravity right now. Enterprise software.
Okay, let's hear it.
Why are companies like Palo Alto Networks and CrowdStrike currently trading at extreme, 20 to 30 times forward enterprise value to sales multiples.
Right.
Especially when our daily proprietary updates show their actual recurring revenue growth is steadily declining.
The math doesn't seem to add up. Exactly. We are looking at security annual recurring revenue growth falling from nearly 50% in the first quarter of 2021 to under 20% by the first quarter of 2026. A 30 times multiple implies hypergrowth, but the fundamentals clearly show deceleration.
Well, the disconnect between those soaring multiples and the declining fundamentals is one of the most vulnerable setups in the market today.
Yeah.
The market is currently treating these specific security software firms as AI-agnostic inference plays.
Meaning they win either way.
Exactly. Investors are aggressively bidding them up on the thesis that a growing corporate artificial intelligence footprint inevitably requires a massive expansion in cybersecurity spending just to protect the new data infrastructure.
Okay, but is that actually happening?
Well, that's the catch. They are completely ignoring the reality of the corporate procurement cycle.
Right.
Enterprise AI budgets take time to approve, deploy, and integrate. Those budgets are still 2 to 3 years out. I mean, we are looking at late 2026 or early 2027 before that security spending materializes at scale. Wow, I mean, the market is pricing in an immediate fundamental revenue inflection that simply has not arrived yet.
Correct. Which leaves the sector highly exposed to a severe multiple contraction if their earnings miss the mark.
Beyond technology, we also had several key fundamental corporate drivers print today that highlight the current state of the consumer.
We did, and the results were, frankly, highly fractured.
Yeah, General Motors beat estimates and finished up 2%, showing strong full-size truck demand, which points to a highly resilient consumer segment.
But then you look at Domino's Pizza.
Right. Domino's reported higher carryout volume but lower delivery numbers.
Which paints a very nuanced picture. I mean, consumers still have discretionary income to spend on dining out, but they are actively cutting the premium delivery fees to save money.
It's selective spending. And in the financial sector, Charles Schwab received a positive reception for beating estimates.
Right, largely driven by strong net interest income from their robust capital markets activity.
But on the negative side, we saw fundamental misses from MSCI, Equifax, and Zions Bank Corporation.
Yeah, Zions specifically missed due to lower net interest income stemming from sticky deposit costs.
Meaning customers are demanding higher yields on their cash, forcing regional banks to pay up to keep those deposits.
Exactly. And this validates the broader extreme divergence we see in the financial sector right now.
Because there is a capital market supercycle happening that benefits firms like Schwab.
Right. While broad concerns over deposit cost pressures are leading to severe net interest margin compression for traditional lending banks like Zions.
Which directly ties into how major institutional players are actively positioning their portfolios.
It does.
Our latest run of data shows that traditional asset managers are actively reducing their gross long S&P 500 exposure. At the same time, they are aggressively adding gross shorts that are highly correlated with the rising 10-year real yields we discussed in our macro breakdown.
They are heavily hedging against this rising cost of capital.
On that point, the inflation fears driving the rate hikes and the asset manager shorting are anchored directly in the physical commodity markets, which experienced massive moves today.
Very massive moves.
Yeah, running through today's commodity board, WTI crude was up $1.68 to $84.91. Brent crude pushed past $90 a barrel. We saw gold jumping under 90 basis points to $4,084.
Right.
And silver surging 411 basis points to $58.74. For you at the local level, U.S. average gasoline is now firmly over $4 a gallon.
And the primary catalyst driving this hard asset rally is a serious, tangible escalation in the Middle East.
Yeah, the physical supply chain is being disrupted in real time.
Exactly. I mean, oil tankers are literally making U-turns in the Red Sea right now to avoid maritime threats.
We are tracking Iranian strikes on Kuwaiti infrastructure, too, specifically hitting the Ali Al Salem base and Bubiyan Island.
Right. And the choke point at the Strait of Hormuz is becoming so constrained and dangerous that Iraq is now resorting to a vast fleet of trucks to carry fuel oil overland through Syria just to reroute flows away from the immediate conflict zone.
But hold on. Every trader on Earth can see the oil tankers turning around on the news. I mean, this is highly documented. Isn't this geopolitical premium already fully priced into crude oil?
You would certainly think so.
Because both sides are jockeying for leverage. But historically, neither wants a total shutdown of the strait, so the market typically perceives a cap on the right tail risk for crude. Why would institutions be surprised at this point?
Well, that is a fair assessment of crude oil specifically, but Using our latest run of data, the real hidden risk is not in crude. It is in refined products and natural gas.
Okay, how so?
We have structural Russian refinery outages continuing to choke global distillate supply. Plus, European natural gas forecasts for the end of 2026 have been drastically raised.
Like the nuclear supply.
Exactly. The window for Europe to replenish its inventories before the winter heating season is tightening rapidly. So because of this compounded risk, institutional dealer desks are not just buying crude oil futures.
What are they doing?
They are actively executing long positions on the European diesel time spread.
Wait, let us clarify that for the listener. A time spread means they aren't just betting the outright price of diesel will go up today. They are betting that the price gap between December and March is going to explode because of winter shortages, right?
Correct. They are specifically looking at the spread between December 2026 and March 2027 contracts.
I see.
Institutions use spreads because it isolates the specific risk of a winter supply shock while lowering their margin requirements compared to buying outright futures.
Which is very capital efficient.
It is. And that time spread is exactly how sophisticated capital is hedging against a persistent geopolitical shock that spills over into refined products when demand peaks.
Pulling back from the granular data, we need to connect the dots across these asset classes, rates, equities, and hard assets, to define the current economic regime for you.
Indeed.
When you synthesize the data across the board, the regime we are operating in is clearly defined as higher inflation, higher growth.
Which is an unusual combination.
Yeah, because normally inflation destroys growth, but the U.S. consumer remains surprisingly resilient. We see that in the Capital One data, where nominal income growth is actually outpacing inflation for certain cohorts.
Right, and we see it in General Motors building and selling every full-size truck they can produce.
That supports the broader growth narrative. But simultaneously, we have companies like 3M openly warning about massive energy cost pass-throughs.
Yeah, that was a significant warning today.
They are raising their oil inflation estimates to a $150 to $175 million headwind, which they intend to fully pass on to you through direct price actions.
And that unprecedented combination of higher growth and higher inflation is causing a total breakdown of traditional cross-asset diversification.
Yeah, the old models are breaking.
Exactly. If you rely on a standard 60-40 portfolio theory right now, where bonds are supposed to act as a parachute when stocks fall, it is failing. The correlation has shifted.
The parachute has a hole in it.
Pretty much. Equity momentum and artificial intelligence enthusiasm are completely dominating index returns on one side of the portfolio, while physical energy constraints and the resulting restrictive monetary policy expectations dictate the downward movement of macro assets on the other.
Which leaves us with a critical, provocative question to consider based on today's market mechanics.
Go ahead.
If traditional diversification is breaking down and institutional asset managers are actively building massive short positions tightly correlated to rising 10-year real yields, how sudden and violent will the correction in high-beta tech stocks be if energy markets force central banks into an unexpected aggressive rate hike cycle?
That is the $500 billion question.
To quickly summarize today's core takeaways, global rates are climbing under the dual pressure of a $489 billion AI debt wave and sticky global inflation. The equity markets remain trapped under mechanical options gamma ceiling at 7,515, masking deep software valuation risks. And energy markets are breaking out on severe Middle East supply constraints, forcing institutions into complex diesel time spreads. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus will be back tomorrow with the latest market color.